Hi looters, welcome back to Tick to Loot market updates for August 16th, 2026. Before we dive in, a quick reminder. This video is for educational purposes only and is not financial advice. Markets carry risk. Always do your own research and consult a licensed financial advisor before making any trading decisions. Let's jump into what moved the markets yesterday and what to watch today. Starting with yesterday, equities finished the session mixed. Some indices nudged higher while others slipped. At the same time, bond yields climbed, signaling that investors were demanding a higher return for holding fixed income. Those rising yields coincided with a noticeable dip in the US dollar. The combination of a weaker dollar and higher yields set the tone for today's Forex landscape, because currency values often react to both interest rate expectations and relative strength of the greenback. Why do those yield moves matter for Forex? Higher U.S. yields increase the cost of borrowing dollars, which can make the dollar more attractive in carry trade strategies. But when yields rise faster than expected, the market may anticipate tighter policy, prompting a short-term pullback in the dollar as traders reprice risk. So the rise in yields we saw yesterday is a double-edged sword. It can support the dollar in the longer run, yet also sparked a short-term dip that we're still seeing ripple through the FX pairs. With the greenback slipping, we typically see the euro and the pound gain modest ground against the dollar, while the yen, often a safe haven, may also edge higher as risk sentiment steadies. Traders are watching those moves closely because even a small shift in the dollar can translate into meaningful price changes for the most liquid pairs. The key takeaway is that today's price action may be more about how the market interprets yesterday's yield-driven dollar dip than about fresh data releases. Turning to today's calendar, there are no major economic releases scheduled. That means the market isn't being driven by fresh fundamentals, so traders are likely to focus on technical levels, sentiment cues, and any lingering effect from yesterday's yield and dollar moves. In a quiet data environment, price patterns and order flow can become the primary drivers of short-term volatility. Looking ahead to the rest of the week, the calendar remains relatively light on headline-making releases. When the schedule is thin, market participants often turn to technical setups and risk-on/risk-off narratives to guide their trades. Keep an eye on any surprise data or geopolitical headlines that could break the calm, but for now, the market rhythm is likely to stay anchored to yesterday's price action. A recent headline from Investing Live highlighted that retail traders are rethinking traditional prop firms. The gist is that many independent traders are seeking more flexibility, lower fees, and direct control over capital, which can shift where liquidity is sourced. If a noticeable number of traders move away from prop desks, we could see subtle changes in order flow, especially in the more liquid pairs where prop firms traditionally provide a steady stream of trades. That potential shift in retail behavior could translate into a modest uptick in short-term volatility. When retail participants trade more independently, the market may experience tighter spreads or occasional price gaps as the traditional liquidity cushion adjusts. It's something to keep on the radar, especially if you notice sudden moves that aren't linked to scheduled news. From a technical standpoint, euro to US dollar is hovering near a recent swing high, with a support zone a few pips below. Traders often watch those zones for clues. A break above could signal further euro strength, while a bounce-off support may hint at a pullback. Without fresh data, price action around those levels could become the main narrative for the pair today. Commodity-linked currencies like the Australian and Canadian dollars are also feeling the ripple of the dollar's dip. A softer greenback can lift those pairs, especially when global risk sentiment stabilizes. Keep an eye on any price moves in commodities themselves, as they can reinforce or counteract the currency reaction. Overall, the market is balancing two forces: rising yields that can be interpreted as a risk-off signal, and a weakening dollar that often points to a risk-on environment. This tug-of-war can create choppy price action across the major pairs. Traders are likely to watch for which narrative gains the upper hand as the day unfolds. That wraps up today's market snapshot. Looters, remember, we've covered yesterday's mixed equity moves, the rise in yields, a softer dollar, a quiet calendar, and the evolving retail trader landscape. This is educational analysis, not advice, so do your own research before making any moves. If you found this update useful, hit subscribe and ring the bell for tomorrow's Tick to Loot briefing. See you in the next video.